When it comes to my options portfolio, I have outperformed the S&P 500 year to date, which has been down around 9% versus my portfolio, which is down around 2%. I know you're thinking, hey, that's not like you're up 100% or anything. I'm still beating the markets technically on a percentage basis. And yes, since the beginning of the account, it is also slightly beating the S&P 500. So I did want to talk about though how I've adapted my strategy a little bit going into 2022. My thought was value was going to outperform growth with all of the headwinds that we're going to face with interest rates potentially. And that's kind of how I've traded it in terms of going bullish on commodity stocks as well as banks and being less bullish on tech or growth. We've also had a lot of volatility this year. When there's a two-sided market and we go sideways or it's choppy, I can play both sides. So I can go long when we're oversold, and when things heat up or bounce back, I can put on some hedges. In my weekly portfolio tracker, I have a list of all the option trades I've made, and you'll see a theme. So when it comes to selling short puts, which is a bullish position, I've sold it in ticker symbols like Cleveland Cliffs, which is a steel company, Bank of America, XLF, which is an ETF related to the financial sector. And when it comes to selling credit call spreads, which is a bearish position, IWM is an index ETF for the Russell 2000, QQQ, you see down here, this is the NASDAQ, and then you see these huge blocks of covered calls. So these are positions that I've carried forward because they haven't necessarily gone my way right away. So for AT&T, I sold a put initially, got assigned on shares, and I've been selling calls against those 100 shares, collecting more income. If AT&T stays the same or drops, I go ahead and resell a call and continue to lower my cost basis. For some of them, it's a little tougher, like SoFi and Clover Health, because they did take big corrections. It's going to take either a pretty big bounce in the stock or a long time for me to recover. I mean, it's not like I'm some trading god where I never lose money, right? It's more about making optimal decisions enough times where in the end, you're beating out the market. Well, that's the hope, right? Anyway, it's harder to talk about previous trades, so let's talk about my current setup in the options portfolio. Overall, my theta numbers are positive, meaning with every day that passes, if the market just stayed the same, I'd be making around $5. And the delta is 14, meaning that I have a slight bias to the upside. So if the S&P 500 SPY goes up $1, then I would make around $14 theoretically. And then when it comes to the buying power that's being used in the portfolio, I definitely still have some dry powder on the side. This is what I would consider smaller sizing. Usually the optimal setup for theta would be a target of around 0.1% of the portfolio. So theta would be closer to 12. So right now you see with 5, it's definitely on the lower end. And usually when the VIX is elevated like this, I do like to get my position sizing bigger. There is just one thing that makes me not want to go absolutely massive in terms of position sizing. And it's because the reason behind the VIX exploring the upside is a little different from a normal situation. Normal situation meaning Jerome Powell says something that the market gets upset at. Maybe you have a political event or an election where there's some uncertainty, so the VIX gets elevated. Those are situations where I have strong confidence that there won't be some black swan event and the market could potentially go down 5% overnight. Whereas right now with a geopolitical event, yes, the VIX does spike, but with the current setup, you're dealing with Putin, who's an absolute madman, and I honestly can't predict what happens, right? Thursday night, the futures were down like 2% because there was a nuclear plant that was being fired at with missiles. I don't want my sizing to be too big in terms of going super bullish or super bearish because there's a chance he does pull out, hopefully. I don't know, some type of diplomatic solution. Who knows? If that happens, then you could get a massive rally. So that's why I'm keeping my sizing a little lower. Outside of the covered call positions, which is pretty routine of me just selling calls every month, I have 2 positions in QQQ. I have a credit put spread as well as a credit call spread. And the sweet spot would be between 345 and 355 on the Qs. And when we look at the chart of the NASDAQ, you'll see 345 and 355 is a pretty small zone to land in. And the game plan going into this week was to actually get rid of that credit put spread if we got to around that 355 level. We just fell short of that, getting to around 350. We had the talks from the Fed testifying in front of Congress, and Jerome Powell basically came out and gave us the March meeting numbers when it comes to the federal funds rate going up around 25 basis points. price, which was taken well by the market because that was pretty much already baked in. So we did get a bit of a rally. We hit that 350 area. I didn't love breaking down below 340 today. And that is why I ended up selling a credit call spread in QQQ to give a little bit more short delta to add theta when the IV is high. And let's take a look at the implied volatility for some of these products. If you look at my watch list or grid of ticker symbols that I tend to trade, you'll see QQQ up here, SPY, XLE, XLF, right? These are all ETFs. And when I can trade these and the IVRs are close to 100, that means the implied volatility for these products are close to 52-week highs. Then I'll focus on those versus individual stocks just because there's less company risk. You know, if I trade Bank of America and something comes out specifically around Bank of America, I get hit. But if I trade XLF, which is a financial sector ETF, and something bad comes out for Bank of America, doesn't necessarily take down my whole trade. But you'll see QQQ at 90. So having a put spread as well as a call spread, if the market slightly goes up into that zone, that's kind of the sweet spot where volatility contracts and I make money on both spreads. Now let's talk about XLF. We saw that the IVR was elevated, so selling a put in XLF makes sense because we're able to collect more premium. With XLF, I do have a bullish sentiment towards the financial sector. With interest rates rising, I believe that financials are a pretty good sector to be in, especially in this environment, because as the interest rates go up, that should help banks. Banks are already trading at lower multiples, so they're not trading at extremely high multiples, even though people kind of know that the rate hikes are coming. The economy's in a good position, so I don't think there's going to be some rug pull where all of a sudden companies are defaulting on all of their debt. Remember, I mean, these trades are looking for a month to 2 months out. Sold a put in the April expiration for a $102 credit, and I went ahead and sold the 35 strike price. We're talking about falling below October levels in order to even be tested in this position. If we did go below 35, I would happily take assignment on that position. The plan for trading in 2022 is to not fight the trend until it reverses. Value is the play and growth continues to get hurt. If you're wondering what I mean by value specifically, I'm talking about sectors that are a little bit more cash flow heavy or defensive. So we're talking about utilities, consumer staples, financials, industrials, healthcare, some of these more stable type companies, and the focus now on current cash flows versus future cash flows is what I'm looking for. So companies that are trading with a little bit more reasonable of a PE and not so focused on the future potential. I do want to address energy specifically because with everything going on in the world and the fears that there may be sanctions on Russian oil, that is causing a huge spike in crude oil. And so energy has been doing well. My problem with trading it is that is more of a binary event. If OPEC comes out and says they're going to increase capacity and supply, that may cause crude oil to go down. If the situation in Ukraine escalates, we could see an increase in oil. So it's definitely less predictable in my mind. So even though IV is higher, I'm avoiding it from a trading perspective. And I'd rather be invested in oil right now versus just trading it on a short-term timeline. The paired trade that I'm essentially doing is long value and short growth and trying to play the up and down movements of the market within certain channels. But honestly, outside of the geopolitical risk, which is hard to predict what's going to happen, if that does go away and things calm down there a bit, I do believe eventually growth kind of runs into a situation where there is a max pain point, and I do believe earnings catch up. Evaluations at some point look pretty good. We're talking about the general market, right? Not specific companies. But there is a point where I think we do turn around, you know, somewhere around maybe middle to the third quarter. And the reason I say the third quarter or later in this year is hopefully by then there's more clarity on how many interest rate hikes there's going to be, as well as a targeted number, whether it's going to be 2%, 2.5%. What's the end goal? And once we have that information, I believe growth will fully absorb it. We'll hit max pain on it. And the trend of value outperforming growth may start to go away. So for the Qs, I'm not finding the trend. Right now, it isn't a downtrend. So I'm trading this bearish channel to the downside. And once we get some signs of capitulation and a reversal, that's when I might think of changing my strategy going forward. But yeah, that's my little update on the options portfolio. If you did enjoy the video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we talk options, anything to do with money. Thanks guys for watching, and have a great day.